All right. Good morning, my fellow profit-seeking stock pickers and fellow capitalists. I am Rick Action Jackson, your growth stock guru, and it is Thursday, July 16th. Thank you for joining us. I've got a strategy called the Top Quintile Strategy that's designed to pick stock winners, and I'm going to share three of my favorites this morning, but I want to first disclaim this is not financial advice. I am not a licensed financial advisor. These are just for education purposes on stocks that I like. Do your own due diligence, and by all means, run these stocks by your financial advisor before you buy them. Your financial advisor should agree that the risks involved are appropriate for your situation. The stock market can be dangerous. You can lose money. This show is for people that are going to have no tears if that happens. All right. So our first one on the deck today is Amazon.com. Amazon, AMZN, under 260. I like it. It traded in the 250s for the most part yesterday. It's breaking out. Amazon's been under a black cloud for the last year. Let's go to the chart. They've reported some absolutely stellar numbers. But what's freaked people out is they're investing a ton of money in AI. The amount of money they're investing in AI has doubled every year for 3 years, and they're going to do over $200 billion in AI investments this year, 100 the year before, and over 50 the year before. And every year, they started in January predicting a lower number, and by June, the number is up a lot more. They started this year predicting they were going to do 120 billion in 2026. They've raised that number already to 200 billion. The CEO is very convinced that these investments are going to pay off big time 2-3 years down the road. ASML reported last night and made a very passionate case for why the AI build-out is probably only in its second or third inning, and it's at least 2, if not 3 or 4 more years of this heavy investment. He was comparing it to the railroads. First, you got to lay the tracks, and then the trains will follow. And I would say Jassy at Amazon agrees with that forecast. And so the Wall Street is buying it. The companies that have been penalized for doing a lot of AI investment, they're all up big yesterday, and I think that rally is going to continue. So let's take a good look at Amazon. Now, the Top Quintile Strategy's goal is to only buy stocks that we feel can double in less than 4 years and go up more than 50% in 2 years. And the other key qualification we want to see is that these companies are beating Wall Street's expectations. Amazon consistently beats Wall Street's expectations on revenue. Sometimes on profit they beat, sometimes they don't. They have been beating on profit for the last 8 quarters in a row. Their margins keep rising. But what disappoints people sometimes is they keep increasing their CapEx. They're basically spending almost all their free cash flow right now. But they have been very good at their investments over the years. Let's look at the long-term chart on Amazon. The 5-year, come on. Don't get attitude with me, Mr. Chart. The 5-year, okay, here we go. This is the 5-year. You can see that the stock was all the way up to 182 5 years ago. It dove during the Russia-Ukrainian war, bottomed out in December of 22. So since then, it's gone from 83 up to 254. Don't know many people are going to complain with 200% in 4 years. But the stock for the last year hasn't done a lot. But it's breaking out now, and here's where I think it's going. I think it's going to go to at least 400. My target for 2 years out is 442. And I think it's going to go in 5 years to at least 830. And you can get it today under 260. Amazon is a few fun facts. The second largest e-commerce company in the world, largest Alibaba. They're doing over $700 billion in revenue a year. A couple other interesting statistics. They've got 1.8 million. There are 1.8 million robots in the world. Amazon owns over 1 million of them. They have said that right now their warehouses are 25% run by robots, 75% humans. By the end of 2030, it's going to be 40% human, 60% robot. The robots are enormously cheaper than human beings. Their advertising is growing at over 25% a year. Their same-day delivery is booming. And here's an interesting fun fact. Once a Prime member has same-day delivery of produce available, they tend to triple the amount they order with Amazon. They're massively expanding their produce business. Their Whole Foods chain is 150 billion of that 700 billion. They're growing that significantly. And they're rolling out globally a new version of Alexa that's AI empowered. And in the couple of cities where they've already done it, the average Alexa user, which there are 600 million of, quadrupled the amount of stuff they order from Amazon. So imagine that you just think you need something, just say it, and Alexa takes care of it. It's there tomorrow, or maybe even later today. Their cloud service is the largest out there. It's 142 billion of the 700, growing over 20%. So both cloud and advertising has very good margins, and through robots and cost efficiencies, they're improving the margins on their core business. Another fun fact for Amazon, Amazon's the largest employer of long-haul tractor-trailer drivers. That's a job that's expected to be taken over by robots within 3 years. So you're looking at enormous cost cutting on the core business, very good growth on cloud, Amazon Web Services. They are the largest in the cloud business, and their advertising revenue is growing nicely. They've also got two new businesses coming online here. One is Zoox. Zoox is their robot taxi service. It's available today in 3 American cities. It's going to go to 40 within 3 years. And they also have a new drone delivery service working in, right now they're in 50 different areas, mostly rural, and they're going to be in 600 areas within 5 years. And Andy Jassy, the CEO, has predicted that within 5 years, Amazon's going to double their revenue. They're going to be a $1.4 trillion revenue company, and their workforce will only grow 10%. So revenue is going to grow 100, workforce 10%. The rest of the growth is going to be managed by robots and drones. So they have successfully increased their profit margin 3 percentage points in the last 4 years. I'm only going to predict they increase their profit margin 1% from 13 to 14% the next 5 years. And I think that's extremely conservative. And Amazon trades at a PE of anywhere from 25 to 40. I'm going to use 33. You put a 33 multiple on 1.4 billion in revenue, and you generate a 1% better profit margin than you currently are today. You're basically coming up with about $20 a share in earnings in 5 years. And should be able to put anywhere between a 30 and 40 multiple on that, which would get you up to $600 or $800 a share. You can get it for less than $260 today. Amazon is one of the core holdings in my top quintile strategy. And I think if you don't own it already, you should. And if you do own it, make sure it's a significant part of the portfolio. I'm not a financial advisor. You and your financial advisor figure that out. But normally, I'd want to see you have at least 5% of the portfolio in this, if not more. So Amazon, we love it here. We think it's finally breaking out. Good time to buy it. Next, we have Blackstone, BX. Let's go to the chart. This is the 5-year chart on Blackstone. Let's go to the 1 year. Last year for Blackstone has not been fun, but their earnings have come in above expectations, and they've continued to grow the company 15 to 20%. Why is it down so much? Wall Street had a bit of a panic attack on private credit. What does private credit mean? It means you weren't able to get a loan from a bank, so you went to the private market And the private market's probably charging you 2 to 4% more than a bank would, but you're getting your money. And there are 3 financial companies that participate very heavily in this: Blackstone, Apollo, and KKR. When the SaaS, which is software as a service, apocalypse happened, there are a lot of venture capital-backed private equity software companies that aren't ready for an IPO, but soon will be, that were getting loans through this private credit network. And the rumors got out there that Blackstone had a lot of these. KKR and Apollo have a lot more than Blackstone. And over 70% of the companies that they've loaned money to are companies that they have high equity stakes in. So they're not going to let the companies go bankrupt, because if the debt isn't paid on time, they have to go to bankruptcy, and that wipes out the equity. The reason companies like this borrow money is the less money you have to put in as equity, the higher the return when the profit comes in. So like Blackstone, on its average asset, makes a 13% return, but on its equity, which is the stock, they make 29%. And that's because for every $2, for every dollar of equity they have $2 of debt. And debt doesn't get profits, it just gets interest. And these guys have profit margins in the teens. So it's, as one of my kosher friends say, Booby, when you make money with somebody else's money, do it. These guys use other people's money for 2/3 of their capital. 1/3 is theirs. And Blackstone is literally the guys that are the smartest guys in the room. This has been by far the most profitable and fastest growing financial company on Wall Street for the last 20 years. To oversimplify their business, 1/3 of it's real estate, 1/3 of it's private equity and venture capital firms, and 1/3 of it is insurance and credit. And on their last quarterly earnings, they disclosed that their total exposure to private loans to software companies is less than 1% of their assets. So let's say we write all of that off and they lose all that money, which they're not going to. But let's say we did. They're easily going to make well more than that on everything else to make up for that and still grow 20%. They almost always over-deliver and under-promise. I can't remember the last time they missed an earnings report. It had to be over 5 years ago. To be able to get this company at the current multiple is a steal. This company normally trades between a 30 and a 22 multiple. It's currently at 17. So here are my targets. My 2-year target is $238. My 4-year target is $334. The 228 is a 90% upside. The 334 is 225% upside. If you look at the chart, the 1-year chart, they've finally gotten above their 90-day moving average, and it's approaching its 200-day moving average. When you see a stock trade below the 90 and the 200-day moving average for a significant period of time and then climb back up above it, that stock's ready to roll. So I think it's going to hang out here between 135 and 120 for a few more weeks, although they do have their earnings in 2 weeks. You never know. It might be a blowout earnings report. But for those of you that are patient, I think getting in here under 130 is a great bargain. And like I said, the reasons the stock got beat up never materialized in losses for the company. And with the few private loans they have left to software companies, if those software companies all go bankrupt, it's only going to cost them 1% of their assets. This is a great company down for a silly reason. They're beating the estimates, and it's a great time to buy it. Blackstone, BX, pick it up under 130. Lastly, the third pick we've got for today is Broadcom, ticker AVGO. Broadcom, I can't figure out why this company is so cheap. They've beat the numbers 7 of the last 8 quarters and 14 of the last 16. They're the 7th largest semiconductor company in the world. They normally trade at a 30 to 40 multiple because, unlike other semiconductor companies, their pricing doesn't change much. And every quarter, a semiconductor company becomes more efficient. So if the revenues stay flat, the earnings should go up because They're able to produce more chips at the same cost. But Broadcom's growth has been phenomenal. They are in on the AI trade. They're not only making a lot of ASIC chips and logic chips for the AI motherboard, but they have signed agreements with Amazon and Google to make customized CPU chips and customized GPU chips. You don't need the top-of-the-line chips for all the AI functions out there. And Broadcom's chips are a lot less expensive than Intel's or NVIDIA's. And they've signed long-term contracts with these companies. The CEO of the company said that the deal he just did with Google is pretty much going to guarantee that their custom chip business is going to triple in 3 years. So you go out to what they're predicting for 2027 and just add a modest 20% growth rate to 2028. And I'm coming up with targets that are at $709 in 2 years and $820 in 4 years. The stock's trading under 400. Don't chase it past 400. I think the memory chips are due for a correction. When they go down, it might pull Broadcom down with it, but Broadcom's not a memory chip maker. Their chips are very insulated from the commodity and volatile pricing of DRAM. Normally, Broadcom has a high multiple because it has that protection, but it's currently trading at 17 times earnings. I've rarely seen it this cheap. And I think when the memory stocks calm down, people will see that this is a very stable business. It deserves a higher multiple. And they're going to triple their custom chip business in 3 years, and they're going to increase their business 50% the next 2 years. This is a great time to buy a high-quality stock. It's not having problems. It's been bouncing between the 90 and 200-day moving average. It's not a bad place to pick up a good stock like this. And their earnings are in 2 weeks, and I'm expecting a very strong report. So if you like this idea, pick it up before the earnings report. Buy it under 400 and under 380. I love it. But you may not be able to get it at 380. That's all we got for today, folks. Thanks for checking in, and we'll see you down the road. It's Rick Jackson, the Growth Stock Guru.